Hi, I'm Jimmy. In this video, we're looking at different economic indicators to see if we can answer the question, does it make sense to invest now or wait for the stock market to crash? We're going to kick it off with one of the more relevant indicators recently, and that's inflation. And we can see over the past few years, inflation ramped up, but then it pulled back down. This is one of the purposes of the Federal Reserve increasing interest rates, but we'll come back to that in a minute. Now, it doesn't make sense to just look at inflation in isolation. Inflation, by the way, is the increase of the cost of goods and services. Similar to that, it makes sense to also compare this to wage growth as well. This is the average wage growth in the United States. So, in theory, as wages go up, well, prices can also go up a bit. Well, we can see that wage growth went up, and yes, they have had a pullback in the past few months, along with inflation, just not nearly as much of a pullback as inflation had. This is a good sign for the overall economy. Now, for anybody who says, well, wages have pulled back and we can't just discount that, I just want to point out that over this average, going back to 1999, the average wage growth during this time period is about 3.6%. So when we look at the current gap between the average and the current state of wage growth, well, the numbers still look pretty good. Never mind the fact that it's way above where inflation's clocking in right at this point. So when we jump over to our economic scorecard, well, I think we got to give both of these points to the bulls. Don't worry for all you bears out there. We got a few of those coming in a second. Okay, now we know that the Federal Reserve increased interest rates. The point of increasing interest rates is to try to slow the growth of the economy. Higher interest rates usually slows the growth. That can be a bad thing for the broader economy. One excellent example of that is a new chart that we're going to look at, and this is the average 30-year fixed mortgage rate for prime borrowers. So if you have top credit and we're going to get a mortgage today, on average, we would be paying over 7%. Again, this chart goes back the past 20 or so years, and this number is really quite high relative to the past 20 years. So although these numbers haven't perhaps rippled through some other economic indicators just yet, this is clearly a bad sign for the economy. So jumping back to the economic scorecard, with how high interest rates are, has to be a point for the bears. This is tough for mortgage borrowers, for credit card borrowers. We're going to come back to that in a second. Also tough for companies that have to borrow money. Higher interest rates cost everybody more money. Okay, let's move along. Okay, now coming off of that mortgage rate chart, I think it makes sense for us to look at some housing numbers. So this is a chart of existing home sales, the average cost of existing home sales, the average price. How much is our house worth? And we saw it pulled back, but then it sort of rallied, which is kind of counterintuitive to higher interest rates. Although I will point out that generally the summertime is pretty good for houses being sold, so there could be a certain amount of that in there. But to really get a better understanding, let's go a bit further and look at housing starts. This is the number of new houses being built, and the numbers are ramping up. And yes, recently they did pull back a little bit, but they're not doing nearly as bad as I would have expected. When we saw that interest rate chart up near the high for the past 20 or so years, I would have thought that this would have been worse. Would have thought that housing prices would have taken a bigger hit, and perhaps housing starts would have also taken a bigger hit. Now, I don't want to say that these are bullish points that it has held up. So when we jump over to the economic scorecard, I'm actually going to go in the middle on these two and call these two a neutral point, which is why I'm giving it one to the bull, one to the bears, but they're smaller points. I just think that's a logical way of doing it, only because it hasn't affected it yet, but I do think mortgage rates are going to hurt it at some point if they don't start to drop at some point soon. Okay, now we saw wages were good, but now let's look at unemployment. Unemployment tends to be one of the more popular economic indicators out there, and unemployment is low. It's really quite simple. It is near the low. It has been for a long time. And yeah, it's really clean cut. Now, we could argue with unemployment, the U3 unemployment rate is a bad number to use, but we've consistently used it for this entire time period. And over the past 20 years, it is low. relative to the numbers. Use the U6, it's low. Use any of the other unemployment indicators, they're all indicating that unemployment is quite good. So this is an easy one. When we jump back to the economic scorecard, this is clearly a layup for the bulls. Okay, so we know a lot of people have jobs, and that's a good thing. But now let's jump over to debt, in particular, household debt. So this economic indicators measures the amount of household debt relative to GDP. So the numbers on the scale there, those are the percentages. We can see back in 2009, it was one of the worst numbers. That was nearly 100% of GDP households had in debt. The number has declined, which is a positive sign. Relative to GDP, debt is declining. But what if we were to go a little bit further and we were to look at a different economic indicator, but instead we were to look at the actual balance, the dollar amount of debt owed? Now, this is debt and credit. So credit cards, and let's say you have a home equity loan that you've borrowed against. Home equity debt and credit card debt and auto loans, things like that would end up in this number. Well, actually, auto loans are out of it, but it's sort of additional debt on top of house and auto loans. But I just want to point out, if we look at a scale over there, that scale is $1 trillion. So just recently, debt, primarily credit card debt, the dollar amount crossed $1 trillion. Now, that sounds a bit astronomical. And when we jump back to the economic scorecard, well, we can see that I actually gave this a neutral point. And you might say, Jimmy, that's insane. $1 trillion in debt, you're giving it a neutral point. The fact that it's declining relative to GDP implies that GDP, that the economy itself is growing faster than people are taking on debt. With inflation, a natural rate of inflation of 2, 3, 4%, numbers are going to grow. They're going to get bigger. 100 years from now, $1 trillion in debt is going to seem small relative to how big the economy will be at that point, assuming inflation stays positive over the next 100 years. So $1 trillion bothers me. I have trouble giving it a bullish point because relative to GDP, it's, declining. But it's also relative to GDP, it has, in fact, done better. So that's why I went neutral. It's kind of a cop-out, but I could easily make the argument in both directions. So I'm not going to hold this for or against the economy at this point. Okay, now let's jump over to the U.S. manufacturing sector. So this is the ISM manufacturing indicator, and the key level here is 50. Anything above 50 is positive growth. Anything below 50 is negative growth. And we can see that clearly it's negative growth. It's been there for a while. It's gotten a little bit worse. It has gradually spread itself from the key level of 50 to lower than that. So this, much like we had a layup for the Bulls before, now we have a layup for the Bears. When we jump back to the scorecard here, this is clearly going to be a point for the Bears. Okay, now let's jump over to one of the most important economic indicators, I believe, for the U.S. economy, and that is consumer confidence. So the consumer is one of the biggest drivers of the U.S. economy in general. And if the consumer doesn't spend, the economy struggles. If the consumer spends a lot, the economy goes. It's really that simple. This U.S. is very consumer driven. But we can see that when we look at this chart, relative to the past 20 or so years, the numbers are quite low. Yes, they have bounced a little bit in recent months, but they're still back in a financial crisis level. They're still pretty low relative to recent years. And this is very obviously going to be, or should be, a point for the Bears. So jumping back to the scorecard here, this is an easy point for the Bears because consumer confidence is just too important to ignore. And although it's bounced back a little, not enough to make it even a neutral point yet. I think this is a bad sign for the overall economy. Okay, now let's jump over to another important economic indicator in the Treasury yield curve. So this is the U.S. Treasury yield curve. And basically, what is the interest rate you would get paid for borrowing money, for lending money to the U.S. government? You buy treasuries, what interest rate do you get? Well, we can see that short-term rates, 3 months, if you lend money to the U.S. government, so you buy a treasury for 3 months, 5.5 is the interest rate. By the way, 5.5% is an annual number. Numbers are always annual. They should always be annual. So if somebody says 5.5 for 3 months, it's not 5.5 for the 3 months. It's 5.5 on an annual basis. You get a quarter of that. So that's how that works. But here's the important point. See how the chart is sort of shaped like that? That's wrong. It's supposed to be the other way. You're supposed to get paid more for locking your money up for longer periods of time. If we think about it here, I can lend money to the US government. So I give them $10,000. I buy Treasury bonds, 30-year bonds. I get 4.3%. But if I had just bought a 3-month bond, I would have gotten 5.5. Why would I lock up my money for 30 years when I could lock it up for 3 months? This is what they call an inverted yield curve. And the story goes that every recession for the past 100 and some odd years has been preceded by an inverted yield curve. This is inverted. This is clearly a bad sign for the broader economy. So jumping back to the economic scorecard, yes, this is very obviously a bearish point, and the bears sort of take the lead here. Now, the interesting part is what the Federal Reserve does next as far as how they're handling interest rates. Do they keep increasing interest rates to make sure inflation doesn't come back? Do they level off? I doubt that they're going to decrease them, at least not in the next meeting. What do they do, and how does the market react to that could be the key. So to answer the question, do we invest now or wait for the stock market to crash? The stock market, in my mind, actually appears a bit overvalued at this point. A lot of the stock market, given where interest rates are, a lot of the stock market appears a bit overvalued. So I'm hesitating. If somebody came to me and said, hey, would you buy, broad S&P 500 ETFs? I would hesitate at this level. It seems a bit overpriced in general. The average, I think the S&P 500 is currently trading at a PE ratio of about 22. The 50-year average is closer to 18, 19x. 22 is a bit high, so it's a bit overvalued. Now, where I do think we could find individual opportunities, or even individual sectors or industries, would be to identify perhaps defensive industries that maybe aren't getting the favor that, the stock market has rallied a bit, and over the past few months has, broadly speaking, rallied. I think focusing on individual companies, individual sectors, but really targeting value could make the most sense at this point. Besides that, I would be careful of jumping into hot stocks that are, look like they're rallying a ton. Be careful of the landmines that are out there. We don't want to get caught overpaying for companies. That being said, I appreciate you sticking with me all the way to the end of the video. I really do appreciate it. If you're curious to learn more about researching companies, we did a video called 8 Steps to Analyze the Stock. We got a link over here, link in the description below. Thank you for sticking with me. I do appreciate it. I'll see you soon in the next one.